We're with Jefferies International's David Owen. David, good to see you. Thanks very much for coming in. I want to start by asking you how Portugal's position differs from that of Spain, Ireland or Greece.
Well, Portugal's problem has been more of a long burn. It didn't have actually a very deep recession, but inside EMU it's been losing competitiveness, it's got a very large current account deficit, and it's got a very low level of productivity growth. In fact, its debt-to-GDP ratio is a lot lower than that of Greece and is not nearly so worrisome as Ireland's. But the issue here is that the markets want to see Portugal addressing the fiscal problem, so they're going to go through very painful cuts. I should also add that Portuguese growth has actually been surprising on the upside, so it's in a different position altogether to Greece and Ireland.
And as you say, the key issue is making those cuts that are necessary to bring down its deficit. How much of a struggle is it going to be for the government to win the approval?
It's going to be a big struggle. I mean, the budget deficit is again, it's in single digits, but they've got to get it down very sharply. At least that's what the plans entail, and that obviously means tax rises and also fairly severe public spending cuts. So it's like all the other countries with where the markets are sort of beaten up the bond market. They've got to seem to be getting their fiscal problem in check.
Now, if they pass the budget through, the hope is, the expectation is that yields will come down, spreads will narrow, but what if they fail to get this budget?
Well, again, political vacuum, concerned that they won't be addressing the fiscal problems, so the problems for Portugal will probably remain. I should also add, though, that the Portuguese banking sector, we saw from figures released very recently, their reliance on the ECB has actually fallen in September from just under 50 billion euros to less than 40 billion euros. So I'm saying, I mean, the economy is actually recovering. It's not like Ireland, which is in deep recession, or in Greece, which is in recession.
So why is that not reflected in sentiment in the markets?
I don't understand at all. I mean, I could suggest that the Portuguese banking sector has been trying to increase lending domestically, but it's seen an outflow of foreign deposits. It's also found difficulty funding itself in the interbank market. So it's, of course, gone to the ECB for finance, but as soon as the figures are published, that then became a concern for the bond market. But I think it's important to distinguish Portuguese problems are more long-term. It's more about not having enough productivity growth. It's lost competitiveness inside EMU. It's got a very low level of education attainment amongst a lot of the public. That's what came over in the last OECD report, and it needs to address those issues, which are much more longer term in a sense.
And how difficult is that going to be?
Oh, it takes years. So what we're reliant on is really the markets having the patience to see these things through. But in terms of improving productivity growth, these things take 5, 7, 10 years. Whereas in Ireland's case and Greece's case, it's much more a case of trying to get the budget deficit down quickly. In Portuguese case, it should be more about trying to resolve the longer run issues with productivity growth.
OK, well, thank you very much indeed, David Owen, Chief European economist for Jefferies International. Good to talk to you.